We've had a busy day here in the office, and we're into the summer vacation season, so there are not as many of us around. And I realized that the market is down today, and I wanted to get a blog out, and uh, we're going to do an audio blog just so that we can move a little faster than I can type. First off, as I'm speaking, market's down 260 points or so, and pretty much directly related to the earnings results of Bank of America and to a lesser extent JP Morgan yesterday. And I want to come back to that because, as you know, in our most recent blog, written blog that is, we suggested that we thought and still do believe that earnings will actually, when we're done with the whole season, that earnings will actually outperform what the analysts are now expecting. And to that end, I want to deal with a couple of things first. We're very early in the season. Indeed, at this moment, only 23 of the S&P 500 stocks have reported. For the purposes here today, I'm going to extract the financials, the banks, and I'm going to just look at regular corporations and how they're faring so far in their earnings announcements, how they're faring compared to the analysts. First off, 16 stocks have reported basically this week, and the numbers are really quite eye-opening. Of the 16, 15 have been positive, one has been negative, and in terms of surprises, 14 surprised to the upside, 2 surprised negatively, and the average surprise has been 10.77, call it 11%, and remarkably, the average earnings increase over a year ago for the first 16 companies is nearly 120%. So we realize a year ago was weak, but earnings are up nearly 120%. Then if we include the financials, we see another sort of interesting picture. 23 companies out of the S&P 500 have reported. 19 have been positive. 3 have been negative. In terms of surprises, 20 have surprised to the upside, only 3 to the downside. That's a remarkable ratio so far. The average growth on a year-over-year basis is, listen to this, over 300%. Now, that is colored dramatically, as you can tell, by the financials, because if we exclude the financials, as you remember, the growth on a year-over-year basis is about 120% for the non-financials. And that kind of then brings us to the problem of the day, and let me spend just a few minutes on the problem of the day. We've had Bank of America and we've had JP Morgan report. JP Morgan reported earnings that were just extraordinarily above the estimates, but the revenues were a bit light, and so they were not rewarded with a big up day yesterday, even though the earnings were way above estimates. And the reason is that obviously there's a new set of banking regulations that's coming down the track, and there are questions of, you'll read this in the newspaper, there are questions of the macro economy. If revenues are weak or less than what are expected, that would mean that the overall economy is not very strong. So the reason that we're down 260 points today is really Bank of America. Bank of America came in sort of light everywhere. The revenues were very unexceptional. The earnings were very lumpy, meaning that there were all kinds of adjustments, and I'm not going to get into them here. But The very long story short is that in the case of both Bank of America and JP Morgan, the earnings largely came from reduction in loan loss reserves. Now, let me say that again. They largely came from reductions in loan loss reserves. That actually is a good thing because that's the whole problem. These banks have created hundreds of billions of dollars of loan loss reserves. They put them on the books, and they put them there long before they actually know what the losses are going to be. So the fact that they actually now, in the case of JP Morgan, for the third quarter in a row, they're reducing loan loss reserves, that would be a good sign. That would be saying that the real estate market isn't as bad for the banks as what they thought, a year ago. But the reduction in loan loss reserves is a very subjective decision, and it's made by management. And so today, because Bank of America, their numbers were actually weaker than JP Morgan's yesterday, it calls into question, well, did you guys really reduce your loan loss reserves by the right amount? Because are things that much better? Or did you just do it to increase your earnings? So there's questions about the banks, but let's move away from the banks. A lot of people had questions about the banks on the way in. They're going to have questions about the banks on the way out. The key thing in our judgment about the earnings season and stocks through the rest of the year is how do the non-financials do? And in my eye, so far, they are doing extraordinarily well. And I'll close with this. Next week, listen to this. We've got Pepsi, Whirlpool, Illinois Tool Works, Wells Fargo. That'll be a huge one. 3M Corp, Goldman Sachs. That'll be huge. Apple, Johnson & Johnson, Coke, Eaton, and Caterpillar, among others. It's a huge week. We will know a whole lot more by next Friday what earnings are looking like. But I'm betting, and all of us here at DCM are betting, that these earnings are going to continue to surprise to the upside, and they are eventually going to help stocks regain their footing. That's all. Just wanted to, as I say, do an audio that we could do quickly and get something out to everyone. And have a great weekend, and thanks for listening.